In spring 2025, US-China relations hit a breaking point. President Trump, back in the White House, reignited his trade war, announcing a massive tariff hike on Chinese goods, from 54% to a staggering 145%. The move shocked global markets, signaling the end of cautious engagement and the start of aggressive economic nationalism. The administration claimed the tariffs would protect American jobs and force China to change its trade practices. But Beijing responded with fury, calling the move economic bullying. China retaliated with its own 125% tariffs, targeting key U.S. exports like natural gas. The world braced as the two largest economies locked into a tit-for-tat escalation, with the fallout threatening to reshape global trade. The stage was set for a high-stakes economic showdown. A tariff is a tax on imported goods, imposed by a government to control the flow of products coming into a country. Tariffs have been used for centuries as a tool to shape trade policy, influence economic growth, and protect domestic industries from foreign competition. By making foreign products more expensive, tariffs encourage consumers to buy locally made goods, which can help domestic businesses thrive. However, this also means that shoppers often face higher prices, especially for everyday items that rely on global supply chains. While tariffs can protect local industries and generate government revenue, they almost always lead to higher prices for consumers. This can be especially tough for families on tight budgets, as the cost of essentials like electronics, clothing, and even food can rise quickly. For example, a $500 Chinese smartphone with a 20% tariff suddenly costs $600, making the American-made alternative more appealing. This price jump isn't just a number, it directly affects what people can afford and the choices they make at the store. Tariffs disrupt global supply chains, raise production costs, and can trigger inflation. Companies may have to find new suppliers, pay more for materials, or even cut jobs to stay afloat. The Trump administration's 145% tariff wasn't just a tweak, it was a near ban on many Chinese goods, forcing U.S. businesses to scramble for alternatives. Many companies had to rethink their entire sourcing strategies, leading to uncertainty and higher costs across industries. Retaliation is inevitable, trade wars erupt, hurting exporters, shrinking global trade, and creating uncertainty that stifles investment. When countries respond with their own tariffs, the effects ripple through the global economy, impacting jobs and growth worldwide. The cycle of tariffs and counter-tariffs can spiral, impacting economies far beyond the original dispute. Even countries not directly involved can feel the shockwaves as global markets react and supply chains are forced to adapt. In 2025, these dynamics exploded on a scale the world hadn't seen in decades, sending shockwaves through financial markets, disrupting businesses, and changing the way nations think about global trade. China didn't just match U.S. tariffs. It struck at America's financial core by selling off U.S. Treasury securities. Treasuries are IOUs from the U.S. government. For years, China was one of America's biggest lenders. By selling these bonds, China aimed to drive up U.S. borrowing costs, making it more expensive for the government to fund everything from infrastructure to social programs. The move was a clear escalation, weaponizing financial markets and signaling that the conflict had moved beyond trade. As yields on U.S. debt spiked, the message was unmistakable. China was willing to destabilize the system it once relied on to push back against U.S. pressure. This financial counteroffensive sent shockwaves through global markets. The economic war had entered a new, more dangerous phase. Despite the dramatic headlines warning that China was dumping U.S. debt, the reality was more nuanced, a steady, calculated, and strategic sell-off that unfolded over several years. Rather than a sudden panicked exit, China's approach was measured, reflecting careful planning and long-term economic goals. This move was closely watched by global markets, as investors and policymakers tried to interpret what it meant for the world's two largest economies. By May 2025, China's Treasury holdings had dropped to $756.30 billion, the lowest level since 2009, and a dramatic fall from the peak of $1.32 trillion in 2013. This decline didn't happen overnight. It was the result of a persistent, years-long reduction in exposure to U.S. government debt. The pace of the sell-off picked up significantly after the U.S. imposed tariff hikes, with China offloading billions of dollars in treasuries each month. This acceleration signaled a shift in China's attitude toward holding U.S. debt and sent ripples through global financial markets. As a result of this ongoing reduction, China slipped from being America's top foreign creditor to third place, now trailing behind both Japan and the UK. This reshuffling of major U.S. debt holders marked a significant change in the global financial landscape. But this wasn't just about numbers. It was part of a broader, deliberate strategy by Beijing to reduce its reliance on the U.S. dollar, diversify its foreign reserves, and insulate itself from potential U.S. financial pressure or sanctions. China began investing more in gold, other currencies, and alternative assets. Back in 2011, China held a staggering 14% of all foreign-owned U.S. treasuries. By 2025, that share had shrunk to less than 3%. This dramatic drop underscored just how much China had scaled back its role in financing America's debt. The message from Beijing was unmistakable. China no longer wanted to bankroll America's deficits, and was willing to take concrete steps to reduce its exposure. This sell-off wasn't just a reaction to recent tensions, it was a dramatic intensification of a long-term trend that had been quietly unfolding for more than a decade. The implications for U.S. debt financing were profound, raising questions about who would step in to fill the gap, how borrowing costs might change, and what this shift could mean for the future of the global financial system. China's Treasury sell-off had immediate real-world effects on U.S. markets. Yields on 10-year Treasuries spiked, pushing up borrowing costs for the government, businesses, and consumers alike. Mortgage rates, car loans, and corporate debt all became more expensive, slowing economic activity. Stock markets plunged into volatility, with companies exposed to China suffering sharp losses. Analysts debated whether China's moves were calculated to maximize turmoil, but the outcome was clear. U.S. financial markets were rattled. The interconnectedness of the two economies had become a weapon in itself. The idea of China dumping all its U.S. debt sounds like a nuclear option, but it's a double-edged sword. A rapid sell-off would crash the value of China's own holdings, inflicting huge losses on its central bank. It would also strengthen the yuan, hurting China's export-driven economy by making its goods more expensive abroad. Instead, China pursued a gradual reduction, letting bonds mature and selling slowly to avoid self-inflicted damage. This war of attrition still pressured U.S. interest rates, making debt financing more costly over time. The strategy was subtle but effective, weakening the U.S. position without triggering a global meltdown. The financial conflict was now a slow, grinding squeeze. The trade and financial war hit Americans where it hurt, their wallets. Tariffs drove up prices on everything from electronics to clothing, acting as a hidden tax on consumers. Families faced higher costs for essentials, while rising interest rates made mortgages, car loans, and credit cards more expensive. Small businesses struggled with pricier loans and disrupted supply chains, sometimes leading to layoffs. Farmers and exporters lost access to Chinese markets, threatening livelihoods across the country. The promise of protecting U.S. jobs came at the cost of higher prices and economic anxiety for millions. For most Americans, the trade war was no longer an abstract policy. It was a daily reality. The 2025 U.S.-China confrontation signaled a seismic shift in the global economic order. What once seemed like a stable, predictable system was suddenly thrown into uncertainty as the world's two largest economies clashed, not just over trade, but over the very rules that have governed global finance for decades. The old model, China selling goods to the U.S. and recycling profits into treasuries, was breaking down. This arrangement had underpinned global growth, keeping interest rates low and fueling consumer spending in America, while supporting China's rapid industrialization. But as tensions rose, both sides began to question whether this interdependence was a strength or a vulnerability. China and the BRICS Plus alliance accelerated efforts to reduce reliance on the dollar, exploring new currencies and payment systems. They invested in digital currencies, built alternative financial networks, and encouraged trade in local money. These moves were not just symbolic, they represented a real attempt to reshape the architecture of global commerce. If successful, this could erode the dollar's dominance and force the U.S. to pay more to finance its debt. The consequences would ripple through financial markets, affecting everything from mortgage rates to the cost of doing business worldwide. Investors and policymakers alike began to grapple with the possibility of a world where the dollar was no longer king. America faces tough choices: higher taxes, spending cuts, or both, as foreign buyers retreat from its debt market. The political debate grew more intense, with leaders forced to confront hard realities about fiscal discipline and the nation's economic future. The era of easy borrowing was coming to an end. The world is watching to see if a new equilibrium emerges, or if economic blocs harden into lasting rivalries. Will nations find common ground, or will the fractures deepen, leading to a more divided and unstable global system? The costs of economic war are high, and fragile truces offer only temporary relief. Behind every negotiation lies the risk of escalation, with ordinary people often bearing the brunt of uncertainty and disruption. Navigating this fractured, multipolar world will be the defining challenge of the coming decades. The choices made now will shape not just economies but the lives and futures of billions across the globe.